does better. And have an example how maybe Romania take advantage of the ILS market in the future. So this we will not cover. Let's look at a performance of a couple of markets. The light blue one is the stock market index. The green one is BB corporate bond index. And the dark blue one is the Swiss Re cat bond index. And if we look at the years 2008-9, we all know that the financial markets were not in a good shape, and we can nicely see that the cat bond market has done very well. In fact, I believe this is the chart where investors have looked at and said, wow, this is interesting, I should go into the ILS market. And this is the reason why we see today more money coming to the ILS market than ILS and reinsurance actually can absorb. This is not a totally uncorrelated market. If there is a huge earthquake somewhere in the world, it will have an effect on the financial markets, surely. But on the other side, in fact, it is uncorrelated. If Mrs. Yellen in the US or Mr. Draghi in Europe play around with their interest rates, they do not cause a geophysical earthquake. And this is interesting for investors. There is not a real definition in the market, but you can say that insurance-linked securities are financial instruments whose values are primarily driven by insurance or reinsurance events. And you have a more narrow and a wider definition. The more narrow definition really goes to the word securities, which are usually tradable securities. And the major component are the catastrophe bond. And you have a wider sense. The wider sense also includes so-called collateralized reinsurance, which is actually transacted in reinsurance form and not in security form. Generally, I think if somebody talks about ILS, he means the wider sense. It all started in 1994 when Hannover reissued the first catastrophe bond ever. Now, how does it work? You have four components. You have a reinsured. This can be an insurance company, reinsurance company, corporate company. It can be a government, or it can be a semi-government institution. Then you have the investor side, hedge funds, pension funds, all sorts of institutional investors. These are two different worlds, very two different worlds. The reinsurance, insurance world, the financial market world. They're different words, different cultures, different regulation. In the beginning, when I started with ILS, I was talking to bankers. I think we were both saying the same, but we didn't understand each other. So there are often different words simply used. How to bring these two together? For a catastrophe bond, and almost all bonds go back to this basic structure, you set up a special mini reinsurer, a special purpose vehicle. Usually this is in Bermuda, Cayman Islands, or Ireland. There are also other places where you can do that. This is not very costly and is fairly quick. And you need a trust account where you can put money in. Now, the reinsured enters or wants to enter into a reinsurance contract or risk transfer contract with a special purpose vehicle. Let's assume it is a limit of 100 million US dollars of a reinsurance contract. Now, this special purpose vehicle has no rating, has no capital, has nothing. So needs to have money to pay a loss. It needs to have actually $100 million because the maximum loss could be 100 million. So he hedges the risk and goes to the capital markets and issues notes or issues a bond. And he gets so many investors involved that he collects 100 million. So this could be 5 investors who buy a bond of 2 million, who could be 10 investors who buy a bond of 3 million, doesn't matter. He collects 100 million from institutional investors who then get a tradable certificate, a security. The money which is collected in cash actually then goes into a trust account. This money is not aggressively invested, because the idea here is the investor wants the insurance risk. He does not want to have other financial risks. So the money is then sitting there. How does it now work? Usually these bonds are 3-year contracts. If there is no loss, the reinsured pays the reinsurance premium to this vehicle, and this vehicle pays quarterly interest to the investor. So the reinsurance premium is basically converted to an interest payment. If the money in the trust account also generates interest, which nowadays is almost not the case anymore, then it would be paid to the investor as well. After 3 years, if there's no loss, it all will be dissolved and the structure is gone. If there is a loss, now the reinsured goes to the trust. The money is there to pay the loss. This is very, very important. Even if the investors who have bought the notes, if they are insolvent, have disappeared, whatever, doesn't matter. The money is there to pay the loss. Investors actually prefer risks where they can apply a model to calculate probabilities. And insurance or reinsurance companies use cat bonds as part of their strategic reinsurance program. So nobody would replace a reinsurance program by a cat bond, but it's always a certain piece. And this piece is a high security because the money is sitting there to pay the loss. It's basically a AAA security. However, it's not that simple to do this. You need banks, lawyers, modeling agencies, rating agencies. A reinsurance contract can be 30 pages, sometimes less. A cat bond may have 5 files in papers. And in fact, this is a hurdle for many companies to think of a cat bond. You could involve a so-called transformer company, which would be a reinsurer. It's usually Hanover Re, Munich Re, or Swiss Re, who are put in between, and basically the transformer company takes over all these contractual obligations and all these capital market stuff, and the reinsured only has one reinsurance contract with the transformer, so reduces the legal obligations and the work involved. Usually first-time cat bond issuers and catastrophe pools in the world are using a transformer company. There's a variety of trigger mechanisms. Sometimes, I mean, we all know in the insurance and reinsurance industry, an insurance company pays a loss when the loss happens. So if an expensive, I don't know, glass falls down, you get paid the value of this glass. However, for the cat bond business, you can define a different trigger. You can take a parameter, for example. Let's take an example. We'll take our 100 million. Company has bought this cover. Now there is an earthquake of 7.9. The insurance company has a big loss, but there's no recovery under this cat bond. The first thing probably what happens is that the reinsurance manager gets fired because he has done a bad job. So easy to structure, investors like it, but they have this problem of this gap in coverage, which is called basis risk. The coverage which we all know, indemnity, that is, you pay the losses which happened. Investors do not like it so much because they are not used to the fact that you have to rely on somebody else to tell you how the losses are. There are a couple of others, for example, the Industry Loss Index. This goes back to Tom and his company, where he provides the data and the tools to build an index to use that. Let's summarize the pros and the cons of a catastrophe bond, and usually the size is between $1 and $300 million. From somebody who issues a bond, it is more capacity, It's a very low counter party credit risk, and it's a diversification of your reinsurers. Disadvantages, far more complex, more expensive. It's not true anymore at this stage. 3-4 years ago, catastrophe bonds were more expensive than comparable reinsurance covers. 1.5 years ago, cat bonds were cheaper. Now they are probably on the same level. In a 3-year catastrophe bond, you only have one limit. You have no reinstatements. And once the collateral is paid back to the investor, there's also no cover more. So in the unlikely event that you realize losses 5 years later, that's a problem for you because you don't recover them. The investors, of course, they like the diversification. However, it's a small market and it requires really specific expertise. Let's look at the development of this market. In 1994, as I said, Hanover restarted it. About 10 years was not a lot happening. A small group of companies played with it. And then in 2006 and 2007, in particular, Swiss Re was very active. However, 2008, the market crashed. And the reason is simply investors didn't have any money. They went away. Over time, market grew again to a new high, but the last 2 years, it went down. A big debate and discussion in the ILS community. Why? And this has probably to do with the soft market. Currently, it is fairly easy to get traditional reinsurance with a high security, which is simpler than issuing a cat bond. If we look at the diversification of risks, this is from the end of 2015. It was easier to collect that data. It would be the same message today. We have a lot of US here, US multi-peril, US hurricane, US earthquake. Multi stands for multi-peril worldwide, also includes S. So from an ILS investor, it's pretty difficult to build up a diversifying portfolio because it's so heavy US weighted. If Romania or a company in Romania would come up with a catastrophe bond, it would have a good chance to get a good price because ILS investors will like it because it would diversify an ILS investment book. Because there's no Romanian earthquake, for example, covered so far. Let's go back to this picture and let's look at the last 10 years, from 2007 onwards. I will now have the same information in a slightly different scale. This is a scale not that easily visible because it's much smaller. However, this is the amount of catastrophe bonds issued in a given year. Because these transactions are usually 3, sometimes 5 years, there is money sitting with catastrophe bonds issued last year or 2 years ago. If you add on this money, you have this dark blue one. So we can say that in total, today, approximately 25 billion US dollars sitting or invested in catastrophe bonds. This is, however, not the full ILS market. This would be the ILS market in the narrow sense. If we go to this wider sense, we'll come to this picture. And in fact, this green is collateralized reinsurance. If we add this up, we come to 70 billion, and we believe that there is an additional 3 to 5 billion in industry loss warranties. I don't want to go into the details of that, but this is, again, Tom's specialty here because industry loss warranties uses Tom's services to be created. So we can say that nowadays about 75 billion US dollars is with the ILS community, which is about, I think, 15% of the worldwide catastrophe reinsurance coverage. Why has this happening with this green one? Investors don't like it that much. They like catastrophe bonds. A catastrophe bond is a tradable instrument. You can buy it, you can sell it, even during the 3 years term. This is all reinsurance. At the end, this has happened because there's simply not enough catastrophe bonds out there, but there's enough money. So money finds its way. And this is this collateralized reinsurance. also the range of risks covered by collateralized reinsurance is wider than just the cat bonds. So I know that risks from many different countries, Asia, Europe, Latin America, is going to ILS investors, not via cat bonds, but via collateralized reinsurance. How does that now work? It looks very similar to a cat bond. Now you have one seeding company, you have one investor, and this seeding company wants to enter into a reinsurance contract with this investor. Now, again, the investor does not have a reinsurance license. So he needs a vehicle who has a license and sets it up. That's easy. Again, we have one of these reinsurance special purpose vehicles, which has a reinsurance license. Still, that doesn't have any money. So the investor now pays capital or other forms to the reinsurance SPV. The reinsurance SPV puts money into a trust account in the same size as the limit of the reinsurance contract. And once the money is there, the ceding signs the reinsurance contract, and the transaction is done. So this is like reinsurance, but money is in addition put into a trust account to safeguard it. Now you could say, wow, this is much better than reinsurance. I only do it this way. Not good for Hannover Re or Munich Re, but not everything is positive. First of all, you have to negotiate more, you have to set up a trust account. But more critical, at a certain stage, the investor wants to have back the money, which is easy when you know that there's no catastrophe. Then you pay it back right after the risk period. But what happens if there has been a loss, a certain layer has not been hit, but the loss is close to the retention? Then it's unclear whether it may still get into the layer or not. So it's a question, how long can the cedent hold on to the collateral? The investor wants to have it back as quickly as possible. So you have to negotiate so-called collateral release mechanism to make sure everybody knows, one, this collateral, these assets are paid back to the investor. Again, over the last couple of years, about 1/3 of this collateralized reinsurance business is transacted through a transformer company. In this case, the ceding company faces a traditional reinsurer, and the reinsurer does the rest. So he has a reinsurance contract with a transformer. The investor has to agree only one trust account with one transformer, and the transformer facilitates the trade. It's actually Hannover Re, Tokyo Millennium Re, and Allianz Risk Transfer who are in that business. If we sum up about this collateralized reinsurance, the range of risks is far larger as with the cat bonds. The usual volume is a 2 to 5 million transaction, so it's not a 100, 200 million one. The advantage is almost like reinsurance, and investor provides collateral. Disadvantage, you have to negotiate a trust account or letter of credit, and you have to negotiate how to release the collateral. From the investor's perspective, another route to reinsurance, but not tradable. Investors don't like it, but they have so much money, they want to invest it, they go this route. Let me come to an example how ILS could play a role in Romania. And in fact, this has been mentioned a couple of times today, and I think, Daniela, your numbers were very impressive and lead to this. If in a country with a huge natural catastrophe exposure, such catastrophe happens, the government usually is faced with a number of things. It needs to come up with first aid, which costs money. We have spoken about people not insured in all these countries. At the end, the government has to help them. Infrastructure is destroyed. Tax income will go down. If factories are destroyed by an earthquake, they can't produce tax income. So the government has less tax income. or the government face the problem that it has to take money from one project to give it those who are not insured. Last but not least, the sovereign rating of a country may be in jeopardy after such a loss. So all these are reasons why a government could think of issuing a cat bond. Actually, it has happened by Mexico, the Caribbean, and the Pacific Islands. How could it look like? Let's look at Romania. I think we have seen a similar picture before. These are results modeled with ICAR. At the end, the numbers are reasonably correct. I still want to take this for illustration purposes only. So it's not yet a final offer to the Romanian government to sell a transaction, but this could look like around this. So these are all earthquakes with the magnitude 6.5 and greater happening in Romania. If we now look a bit further and look at those which are a bit stronger, and there, those which can cause a lot of trouble, we have created two boxes and a circle. And we think, whether that's true or right, you may tell us, if an earthquake happens in box A or B, or within the circle around Bucharest, these are of economic substance to the government, and if an earthquake of that magnitude happens here, the government needs money. Now you can scale it in the following way, depending on where, let me just go back to this. You see that block B covers also part of the sea. Indeed, an earthquake with an epicenter in the sea can still cause significant losses in the country. So the question is really, where's the epicenter of the earthquake? If it's in the boxes or in the circle, there's a payout. And we have, for illustration purposes, designed this box for box AB and for the circle around Bucharest. The modeling numbers would say the following: attachment probability, expected loss, exhaustion probability, typical cat bond terms. It means the expected loss is basically the burning cost, something which we know. Attachment probability, this is a probability that any loss happens. So approximately, if Romania would buy this every 33 years, there's probably a recovery. And the exhaustion probably means this is a total loss. So approximately every 100 years is a total loss to this. And of course, easy to imagine, if you play around with these scalings of the percentages, or if you add other boxes, it's a different result, but the approach and the technique and the idea is the same. I think this would probably cost today about between 3.5% and 4% in the ILS market if somebody wants to buy it, plus costs on top. Let's go to an example. If earthquake with 7.6 magnitude happens in box A, there would be 100% payout of the pre-agreed number. So if the pre-agreed number is 100 million, then 100 million would be paid out. In box B, it would be 75, and if it's within the circle of Bucharest, it's again 100%. There's no counting of losses. Nobody looks what is really damaged. It is only based on these parameters. That means that the payout can be fairly fast, probably within a week or so, and actually the cash could be used for first aid. So this completes this example. Let me have a few comments on 2 slides on general market movements, tendencies, and trends, and hopefully a little bit the bigger picture. The ILS market is still growing. Not the catastrophe bond issuances. It has gone down a bit, as we have seen, but generally, with the collateralized reinsurance is going up, but not as fast as in the past. Mainly pension funds worldwide, they like ILS. They invest. And there is still enough investors who tell us we have more money allocated logically to ILS, but we have not yet paid it in because there are no opportunities to invest it, and there's a soft market, so the returns are not that good anymore. There's a substantial increase in this collateralized reinsurance business. As we all know, soft market, prices have gone down. Surely the capacity from ILS have contributed to this. But on the other side, as long as all companies, including my own company, show good results, the market will not harden. And of course, the lack of major catastrophes in the world, which almost could have changed last week, but it did not, leads to the softening market. Investors would like to do more ILS, but they can't find the risks. And then there is a kind of catastrophe bond light. A catastrophe bond usually starts with 100 million, is complex, needs a lot of other parties involved, and has a lot of legal and other costs. For smaller quantities, let's say from $25 million, 200 million, you could design a so-called catastrophe bond light. Less legal costs involved, you don't have any rating agencies, you don't have modeling agencies, but you only have a smaller amount of investors who are able and willing to invest. But for this relatively small amount, there are probably enough investors out there. So the cat bond light is a middle version between, it is a cat bond, but it's not so expensive to set it up. So will ILS grow forever? That's not that easy to answer. I have a couple of arguments where I'd say, oh yes. Why? Many regions in the world, and again, this has been mentioned a couple of times today, there's a low insurance take-up rate. I have here the example, earthquake California. I could now easily also bring the example Romania earthquake, which we've heard today. That changes. Of course, this will go to the reinsurance, but also ILS market. New territories, new risks, new index structures. There's a lot of room for development. Investors' interest is still high. And even the returns currently are still okay compared to the even worse returns on other financial markets. However, there are also reasons why somebody could say, no, reinsurance for many years has proven to be a good business model. It provides reinstatements, it is more flexible when it comes to negotiating terms, it covers all sorts of risks, the basis risk is not an issue, and of course the whole business segment of liability business is not covered and cannot really be covered, in my view, by ILS, but reinsurers picks it up. In the ILS community, you can also ask a different question. Will ILS disappear after financial markets will come back, or after we have seen mega losses and the investors have enough and say, I quit? My personal belief is this will not happen, that the ILS market will stay, in particular because fund providers are mainly pension funds who take a long-term view. So my conclusion is for the ILS market, it will grow further, but reinsurance remains a strong business model. Thank you very much for your attention.